The crash we had was sort of a mini crash, Powell-induced, I guess.
5%.
Yes.
I mean, I don't know if I call that a huge crash. Maybe a pullback.
7% in NASDAQ, and I think very much expected. My view is that the market's going to shift to earnings driven, particularly in technology. We saw Adobe a couple of days ago. Netflix last night blew it away, and I think you'll see by the end of next week that this becomes history. And some of the things that are right in the news cycle, if Saudi Arabia comes out clean, then that's over with in 3 days. And to me, the fourth quarter of a 16-quarter presidential election cycle, the midterm is the best. It averages up over 7% if you looked at it back to like 1950. So I think we've got the averages going for us. The only wild card, I guess, would be, will we have a change in the House and maybe the Senate both, and how the market reacts to that. But I think it's good to go. So
you think the wobbliness we've seen in the market, that's already behind us and it's straight up from here?
Absolutely. I wouldn't say straight up, but I certainly think we'll have a good fourth quarter.
James, how about you?
Well, we are positive on the markets, but we do think that there is going to be increased volatility here. In some ways, the big swings that we've seen over the last few days, it's somewhat reminiscent of what we saw back in 2010 to 2012 when we had these risk-on, risk-off type of days driven by big macroeconomic questions. And so, the things that will propel the market from here are obviously earnings. Earnings will still be good, even if we've kind of hit peak earnings expectations, the actual growth numbers will still be strong. And then, of course, there are questions about the Fed. I think the focus right now is on should the Fed stay on this path. To us, the bigger question is, if there is a big market or economic shock, will the Fed have the wherewithal and the impetus to basically act on it the way they had in the past? And that is an open question right now.
There are still these questions about the economy. And just this morning, Credit Suisse is taking down its rating for both Home Depot and Lowe's based on the issues they've seen in the housing market. They're going from outperformed to neutral in both of these cases. They say, just based on what's out there, it wouldn't be a surprise if the weakness in the housing market kind of caught up with these stocks. What do you think about what's happening in housing, what's happening in the broader economy? Are there issues, signs of cracks that say to you that the Fed should slow down?
Well, we think that the overall economy is very healthy. The Fed should continue on its pace. This pace is pretty moderate. We're talking about inflation that is accelerating and an unemployment rate that is at historic lows. So that's kind of the baseline level of facts. Now, with that, though, interest rates are rising. So you're going to see a feedback effect in the economy that is going to slow down certain sectors. But, broadly speaking, the consumer is very, very strong right now.
Sure.
Consumer net worth is at record levels. We think that that's going to keep propelling both the economy and the markets.
Chris, very quickly, if you like stocks in general, is there a sector or a few stocks that you like the best?
Yes, I think in the technology sector, Qualcomm, I think they make a deal with Apple on the courthouse stairs. I think they're a big leader in 5G. And if you want a more expensive stock, Square, unfairly punished, I think gets back to its old highs.